The power of three. Africa's fintech story is often told in pieces. Banks are painted as old legacy giants, telcos are lauded as the saviors of the mass market, and fintechs are the innovative and agile disruptors. But here's the reality. None of these players alone can solve Africa's $330 billion credit gap. The true opportunity lies at the intersection where the power of distribution created by the telcos, the legacy and trust and capital possessed by the banks, and the agility and customer experience offered by the fintechs converge into a three-way force for inclusion and scale. This is the triangle few have mastered, but those who do will define the next decade of African financial services, particularly when it comes to the delivery of access to credit. So in this video, we're going to discuss Africa's billion-dollar triangle of opportunity driven by the tripartite relationship of banks, telcos, and fintechs. If this sounds interesting to you, then let's jump in. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so because on this channel I speak about fintech, digital transformation, and agile strategy. Let's start off by highlighting what each of these players represents at the tripartite table and what limitations they typically have as standalone institutions. This is what essentially makes the case for collaboration, starting with the banks. Banks are labeled the keepers of trust and capital. Banks bring more than large balance sheets and capital. They offer regulatory legitimacy, credit underwriting expertise, and historical context in lending. In most African markets, banks still hold the licenses needed to disburse and manage credit at scale. But banks often struggle with a number of things. High cost to serve for low-income customers, legacy infrastructure, very limited agility to iterate on and develop tailored products quickly. Move to telcos. Telcos are labeled the gatekeepers of access. Now, mobile network operators are Africa's greatest distribution engine. They connect more people than any other platform. The GSMA estimates that by the end of 2025, there will be over 615 million unique mobile subscribers and growing. And they bring quite a number of elements to the table. They offer SIM and mobile money-based KYC. They offer daily customer interactions, access to rich behavioral and transactional data, and an embedded channel for USSD, SMS, and mobile applications. Yet they also still have their limitations. Telcos typically lack expertise in credit, financial compliance capabilities, long-term capital to fund loan books, or the lack of a regulatory green light to actually deploy any capital that they may have. And then we have the fintechs. They are seen as the builders of modern rails and leaders of innovation. Fintechs, especially digital lenders, bring the glue. They connect the systems, build scoring engines, optimize experiences, and absorb risk through technology. They are the innovation layer that sits between banks and telcos, bringing contextual credit journeys and automating everything from the onboarding journey to collections. And in most cases, they also manage the relationships and align the incentives between these parties, which is a critical piece that is often overlooked. But again, most fintechs also have limitations. Fintechs depend on partners for scale. In most jurisdictions, they lack regulatory cover to lend directly without becoming a financial institution themselves. They often struggle with long sales cycles and commercial alignment. Now, if you bring these three players together, they are a winning formula. But standing alone, they are just pieces of a puzzle. So let's talk about where it works, the magic of a true tripartite model. Now, across Africa, some of the most successful digital lending products are three-way partnerships, often invisible to the consumer, but with a lot going on behind the scenes across three different partners. When executed well, these partnerships offer instant nano or micro loans via USSD or mobile app, seamless deductions via mobile money, real-time scoring from telco usage and mobile money behavior, and capital provided or guaranteed by a bank, regulatory oversight embedded into design. For example, Botswana's Instacole model, one of the early success stories which combines a major telco, a bank, and a fintech, is a product that scaled in record time. Each party brought something essential. Orange Money Botswana offered distribution and mobile money integration. Access Bank provided regulatory cover and capital, and the Fintech Ezra delivered the tech and the credit scoring. Now, within 12 months, Instacoli became a staple in Botswana's digital credit space, but of course, this wasn't without challenges, particularly around risk sharing, default management, and regulatory scrutiny. Now, let's segue a little bit into the ugly side of why most partnerships break. The partnership triangle is hard to balance. To quote one of the executives of my banking partners, technology is easy, partnerships are hard. And that's a very true statement. Here are some of the reasons why most efforts falter and the tripartite partnership tends to go sour. Firstly, misaligned incentives. Banks want high risk-adjusted returns. Telcos want more revenue per user. And fintechs want growth and product control. Without a shared success framework, someone always feels shortchanged. Often, the revenue share model is outdated, with banks demanding fixed guarantees, telcos pushing for large cuts, and fintechs left with the operational burden and thin margins. And that becomes a primary breaking point. Second is a trust deficit. In many markets, banks and telcos still view each other as competition and fintechs as outsiders or experimental partners, not as strategic equals. Fintechs in turn may view banks as rigid and telcos as transactional. True collaboration requires a shift from vendor-client mentality to joint ownership, where all parties contribute to the design, delivery, and risk with a full understanding of the dynamics of this unique intersection and realistic expectations of performance and potential. Thirdly is post-live complacency. Launch day gets all the attention. Everyone makes a lot of noise when the journey to launch process is completed. A new market is now unlocked and the product is live. But the reality is that sustaining and optimizing the partnership post-launch is where most tripartite partnerships fail. Issues often arise in reconciliation processes, shared reporting and transparency, handling delinquencies, resolving customer issues across 3 different systems, and managing egos, expectations, and relationships between the 3 parties. Now, here are some lessons from the coalface or lessons from the trenches. Now, as someone who has spent 10 years in banking and spent the last 6 years in fintech working closely with telcos, I've been in the thick of these partnerships, launching, fixing, and scaling them across multiple African markets. Here are a few truths that I've learned, sometimes the hard way. Number 1, the deal isn't done at launch. You're not live until every party is accountable daily, from ticket resolution to reconciliation to non-performing loan management to fee payments and product iteration and improvement. Partnership governance must be built in, not bolted on after the fact. Second is strategic alignment from the get-go is paramount. If all players aren't aligned around the table as partners from the onset, the long-term success is jeopardized from day one. You end up with a big portfolio of loans and customers being served, but partners feeling disgruntled and complaining about the lack of revenue or prioritization within the tripartite. And thirdly, regulators now watch the entire chain. Gone are the days when you could point fingers at others. Regulators in Ghana, Kenya, Uganda, Tanzania, Zambia, and the Francophone regions now expect clear, traceable ownership of customer experience, risk, and resolution across the full stack. You're either all in together or the regulator cracks the whip and takes you all out. A key aspect is also rethinking the commercial model. Too often, partnerships in our space start with each party negotiating for the bigger slice of the pie, or over time, demanding a larger share to meet internal targets. The result is a rigid commercial structure that fails to balance financial inclusion at affordable levels within the natural drive for profit. Take 2 examples. Banks asking fintechs to provide guarantees for unsecured lending products. That shifts the risk unfairly onto the fintech, making it impossible to scale sustainably. Telcos charging fixed fees upfront regardless of performance. That's not true partnership. It shows no shared risk or incentive alignment. In both cases, the fintech ends up squeezed between 2 powerful players, the very opposite of what's needed for growth and inclusion. What's required instead is flexibility. Commercial models that reflect real contributions and market realities. That could mean profit sharing, performance-linked fees, cost of funding models, or some sort of hybrid structure. The key is to move from a rigid one-size-fits-all revenue split to dynamic frameworks that reward origination, servicing, risk-bearing, and customer support fairly. Without this shift, partnerships will remain fragile and scale will be elusive. Now, the regulators also have a part to play. And here's what I think regulators should know and should do. If banks, telcos, and fintechs are Africa's new financial rails, regulators are then the signal system. Their role is not just to govern, but to enable. There are some things regulators can do to better enable this ecosystem of the future to thrive. Number one, regulators can promote tiered licensing. Allowing fintechs to hold limited lending licenses or sandbox approvals creates flexibility while keeping oversight tight. We've seen this happen in Ghana. Also, dual license holding. In the event that a fintech wants to double as a funder, there should be the license to do so as not to be held ransom by banks who are unwilling to take that initial risk. Secondly is incentivizing credit reporting. Regulators should mandate reporting for all digital lenders, telco-based or otherwise, to formal credit bureaus. This is the only way we can create a dependable credit bureau system in a fragmented market like Africa for micro or nano lending. And three, regulators should define risk-sharing boundaries. Rather than banning partnerships, regulators can set clear rules on who bears credit risk and how losses are treated, especially when the bank license is being leveraged and all parties now are essentially licensed institutions. So what does the future look like? I envision a future where we go beyond credit to ecosystem banking. The telco bank fintech triangle doesn't need to stop at lending. The same model can extend into savings products embedded into mobile money, SME finance powered by telco transaction history, insurance distribution with fintech onboarding and bank underwriting, cross-border payments as we are already seeing with remittances and deeper KYC integration. Each product is an opportunity for ecosystem banking, where the end user receives seamless, affordable, relevant financial tools from trusted brands they already use. The winners in Africa's digital finance revolution will not be the biggest or the fastest. They will be those that can partner deeply, govern transparently, and adapt locally. Telcos who learn to listen, banks that learn to share, and fintechs who learn to scale responsibly. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment, and I'll see you in the next video. Cheers, guys.